Welcome to Asian Investors Network, where we help our community prosper and achieve their financial goals. Let's begin. I'd like to introduce our moderator tonight, Prashant. Prashant is a managing partner at Analect Ventures, a venture capital firm that provides early growth stage capital to companies led by Asian founders. So Prashant is an entrepreneur and an angel investor with a focus on AI, blockchain, and fintech. I'd like to now let Prashant take the floor.
Thanks, Sam. Maybe I'll just start with allowing Joseph and Joe to introduce themselves. So Joseph, would you like to start first?
Sure. I'll just kind of give you guys the high level background. I attended U of Chicago undergrad, and I started my career in the Bay Area during the first .com. I was doing consulting, technical sales, and product management for about 5 years. Then I went back and got my MBA at Columbia Business School. And then after business school, I transitioned to financial services. So I worked on Wall Street, doing capital market stuff for about 10 years, mostly structured credit and structured products. I did 8 years in New York and a couple of years in Hong Kong. Came back from Hong Kong in 2014, and I was looking to kind of change industries again. So started investing my own capital in real estate, both residential and commercial. These days, I am invested quite a bit in industrial cannabis, self-storage, and mobile home parks. And around that same time in 2015, I kind of cut my first angel check. If I were real honest, I kind of fell into it and, didn't know what I was doing, or I thought I knew what I was doing. Still kind of halfway know what I'm doing. So I'm sure there are a lot more intelligent folks on the call. I just have a little bit of more, I guess, risk in myself, and I've been at it for a little longer than you guys. But it's an interesting area. I would encourage you guys to check it out. On the angel side of things, I have 72 portfolio companies that I've either done direct or via syndicates as an LP. I've also run several syndicates as a GP. In fact, a couple live right now for those who want to ask questions. The only thing I'd ask, if you're going to ask a question, just turn your camera on so I can see who's talking. But I'll stay late if people want to chat about anything that's discussed. Thanks.
Thanks, Joseph. That was great. Joe, would you like to take over?
Sure. Thanks for having me here. I guess I'm a little bit of a late addition, but really appreciate being here. So yeah, I'm Joe Mahavuthivanji. Went to school in UCSD from the Bay Area originally, and recently moved to Las Vegas. My background's primarily in product and growth at startups of all stages.
Oh. Sorry.
No worries. I guess, spent about 3.5-4 years as a VC, investing primarily in fintech and enterprise SaaS companies, 150 or so portfolio companies, still support many of them. Left venture to start my own company called Mythic Markets, and we turned high value collectible assets like vintage comic books, collectible cards, fantasy art, and video games into publicly traded companies so that anybody could buy, sell, and trade fractional shares and things they love. We recently exited, and we haven't announced it yet, but I guess within this group, we were acquired by a company called Sydecar, and Sydecar is a essentially a fund administrator. We help really anybody become a capital allocator so that they can invest in the entrepreneurs that are changing the world. Also do a bunch of angel investing, closing 4 deals right now, with my own syndicate as well. And invest a ton in, real estate, primarily single family homes, and some commercial. So really appreciate being here.
That's awesome. Thanks, Joe. So I guess in the interest of time, I'll just dive right into it. Joseph, you mentioned that you kind of stumbled into angel investing. I'd love to explore further. Would you like to tell us about how you first started
Yeah, so it basically came down to I knew a couple guys who had a startup. They were looking for money, and I had been investing in real estate, and I was looking to diversify. At the end of the day, I want to be kind of retired with many passive streams of income. So I believe that you should diversify across asset classes, across geographies, across sponsors. So just kind of dipped my toe in the water. Really didn't have a theme these days, and we can get deeper into it on the angel investing side. I tend to be North America focused, business to business only. I don't do things outside of my areas of expertise. Not that I'm expert in other things, but I definitely feel like biotech is an area that would be too much brain damage. I think you can make a tons of money, but it's just very hard. I don't invest in hardware just because I think it's, if I had to choose between software and hardware, it's because of the margins. I think, again, you can make a lot of good money. I just don't understand the vertical well. And I try to stay away from direct to consumer and CPG plays, although I have made a few recent investments in the space. So now I have more thematic investing, and I'm more seed to Series A. I don't do pre-seed. I need to have product market fit. I think before, when I was first starting, I didn't know anything about valuations, even the types of notes or equity or safes. So it's kind of what's on the job training.
Yeah, I found that very interesting because you did come from a Wall Street background, and you had your MBA as well. So one would imagine that you would have your valuations and everything under the belt. So so what was it like when you first started? Like, was it just maybe following some people you knew in the industry, or was it just like kind of a randomized like experiment of sorts?
I would say the first, knock on wood, the first company that I invested in, Extern, is still around. They just turned down a $120 million buyout offer, and I think they're raising something like 30 or 40 million for their Series B. So, look, they are a no code big data AI play, and this was in 2015. Before that kind of got catchy, and I thought that was a novel approach. The company's pivoted several times, from what they originally were. So I don't know if it's luck. I mean, certainly there's some luck involved in everything. But I try to, look for big TAMs, large asymmetric risk. Because I'm not smart enough to figure out a lot of things, but I kind of believe in the rising tide lifts all boats. And then in some sense, I back, the founders, like really sharp guys, and that's most important to me. Are they intelligent? Do I believe they can execute, especially in the early stage? And, can they sell? Do they have traction? And is there a moat? So.
Yeah, absolutely. And I can definitely sense the theme of sticking to your circle of competence, like Charlie Munger would say. Great. I'll move on to Joe. Joe, very similar question. Like, I'd love to learn about how you first started with investing.
Yeah. So, I mean, in truth, like, I feel like I've probably been investing since I was a kid. So, like, I happen to be a really, really into this collectible card game called Magic the Gathering. There may be some others on the call that are familiar with it, but Magic cards are maybe a quick brief for those who aren't familiar. Like Trevor seems to know. Is that it's just this card game. Some people, it's kind of like Pokemon, if you guys are into that too, or Yu-Gi-Oh. And you're like basically a wizard. You cast spells and you try to kill your opponents. And so those cards have essentially skyrocketed in value since then. But back then we also knew that they had value, right? It wasn't like $5,000 or $10,000 like it is today. It might be $5 or $10 back then. And so even as a kid, like, I understood like the value of that stuff, and was, doing essentially trading cards like stock back then, right? Like, I've got a $10 card, you give me $10 for it, or two $5 cards. So and then ride different and then those cars would rise and fall in value, and it was a whole thing. But so yeah, I mean, I guess that was probably the start of it all. And I've got some Pokemon players. And so yeah, and then a lot of it was investing in myself, even learning how to build stuff. A lot of that, like learning how to like rally a team, and just getting a lot of reps in terms of investing in myself. And then just starting companies, right? Like, there's a lot of like sort of more that theme of investing in myself, and then finding people to essentially invest in ourselves together in starting these companies. And so, and then that evolved eventually into venture capital, where it was a slightly different kind of investing. Oh, I guess there's all kinds of like stocks and stuff like that in between, and real estate. But as it pertains to startups, since I think this is what the theme of this this session is about, that allowed me to be exposed to a lot more companies, see what life was like from the other side of the table, understand what really kind of like a first sense in like seeing patterns. And you start to recognize these patterns like very quickly just by seeing lots of different deals and working with founders, and recognizing what there are patterns to success, unfortunately. And so that's kind of what we look for in deals. So, and then that transitioned into, after leaving, starting my own company again, and then exiting that, but all the while angel investing as well. So leveraging all the things I got to learn while investing other people's money into investing my own.
Fantastic. So would you say you started investing other people's money before you wrote your own check, or was it the other way around?
Into startups, yes. So it was definitely like investing venture capital before becoming an angel.
Oh, fantastic. And so what is that like? So, I mean, I gather it's been a few years since you went into venture capital, and now you're writing your own checks. So have you noticed like a distinct change over the years, and the way you do stuff and the way the industry has been?
Yeah, I mean, I think one is just like, the check sizes are different, from a venture check, like a seed check. We do generally like 500K to $1 million. Like mine are like 10 to 50K. And so and then just deal flow in general. Like, at one point it was my job to, meet with hundreds or thousands of founders. And now it's like, where they were coming to me then, now I got to go and kind of like track those deals down. And so, yeah, I mean, it's certainly changed. I mean, I'm raising my own like $100 million fund right now. And so, kind of going back to writing larger checks into more deals. Yeah, I mean, I don't know, they're different, but the principles are, kind of the same, like in terms of how to pick.
Fantastic. Yeah, I'll dig into that a bit later on. I would love to know your processes into like selecting companies. I'll move back to Joseph, and
yeah. So
Joseph,
I guess I wanted to just comment one thing. I kind of went the reverse route. Invested my own money, and then I guess I have some syndicates. So now, technically I'm investing other people's money, although it's not committed capital. So everybody does their own diligence. So it's a little bit different. But you had made a comment earlier about working in finance and capital markets. Certainly I understand how to read financials and things like that, which are helpful. Although, I would say even at the early stage, seed stage, pro formas, it's just somebody's best guess. I find them highly, well, not inaccurate, but, it's hard to forecast out when you're an early stage company, 3 or 5 years. I just don't, trust those numbers too much. Yeah. But And anyways, the point is that you can learn this. There are so many resources out there, from websites to YouTube. So anybody who wants to get into angel investing, I think I think this is probably one of your questions, Prasant, is it's become a lot more, shall I say, democratized, with the proliferation of syndicates and other tools for angel investing.
Yeah, absolutely. In fact, sometimes that can be like a double-edged sword, because yes, it's easier to invest, but it's also easier to lose money. And so just adding on to your point about some of these projections, typically I'm just looking at like the quality of assumptions. So if people are projecting like 50% month-on-month growth rate for the next 10 years, you've got to think it's not feasible. But like, yeah, I'm looking more of the quality of those kinds of assumptions and other information that people build into the models, rather than the exact number. And I mean, provided it's directionally kind of accurate, that's all I'm looking for, really.
Yeah, absolutely. I saw a deck once would make 2 billion or 1 billion in a year or two.
Yeah.
Well, I mean, also just, to add to that, projections, particularly like at the early stage, is just lying. I mean, it's never, everybody has like a plan, but the truth is that for the most part, it's that's something I either skip, or actually I look at as like a mark against the people, because it kind of shows a little bit of just kind of greenness of the founder, particularly like at the early stage.
Yeah, I think go ahead, Prasant.
No, sorry, I was just please
No, I would say, depending on the stage, like if you're pre-seed where you're just two guys and an idea, then certainly a pro forma is probably premature. Although by the time you have some product market fit in your seed stage, I would think that folks would have a look, again, you're projecting out 3 and 5 years, but would have a better handle on your metrics. And I don't invest in anybody that can't do a pro forma, at least, because even if it's a guess, you're going to be tracking that day by day, week by week, month by month, and that's kind of your roadmap to see if you're hitting your KPIs ultimately. Because at the end of the day, if you run out of cash as a startup, you're dead.
I mean, with that said, like every founder should know the day they will die, like based on how much cash they are and where they are on that particular day, and when they have to go back for more cash.
Definitely. That's in some ways easier said than done, because I think there's also this psychological block against thinking about it. But yeah, that's a very good point. Which leads me to my next question, which is about some of the more recent changes you've seen since the pandemic. So I'll kind of leave this open-ended. So I'm trying to explore if you've been looking at any particular themes, especially those driven by the pandemic, and also like, let's say, how things have changed in the past 2 years, as opposed to the previous couple of years when you were investing. So yeah.
Yeah, I guess I'll go first. I mean, certainly, with everybody being online, I was cutting checks and meeting people that I've never met in person. I've only recently met some of the CEOs I've invested in now that we started to travel again. So, that was interesting, but I think everybody was doing that. For me, as much as people hate Zoom, as for me, selfishly, I find myself much more efficient, where I don't have to travel to meet somebody into the city, and that whole commute. I can literally, if I wanted to, have back-to-back Zoom meetings all day. So I don't have a team, so it's just one guy. So my bandwidth is limited.
Yeah, that's all.
Yeah, I mean, geography used to matter. It doesn't matter anymore. I would say that like the bulk of the deals that I was doing before were San Francisco, New York, and some LA. Like that's like 98% of the deals. And so, but that doesn't matter anymore today. Also, like, certain themes, the thematically, like there are certain kinds of deals that you're seeing more of, and certainly like less of others, just because, for instance, like retail for a long time was like, yeah, not touching it, or, that sort of thing. And then prices prices have gone through the roof. Like it's insane. You know, I mean, we read about them all the time, and like I see them all the time where it's like a, you know, $50 million pre-seed on like an idea. And it's just like, what? Like there's no discipline anymore. And so you know, still looking for those deals, but then it's also, there is also a reality of you know, what the market is like today. There's just so much cash looking to hedge against inflation, which everybody with like, you know, a brain could see coming. But yeah, I mean, there's a lot of people who failed to hedge and are paying for it.
Yeah, the market, I would agree that, you know, there's been so much money printed that it's super frothy. You know, and some things are out of line. Like if you look at any crypto deals, there's, you know, the multiples are off the charts, sometimes in the hundreds, depending on which day. So but I do think that you know, personally, I'm not an expert, but I plan to take a deep dive into blockchain and crypto and look at that, because, you know, I certainly believe it's a new asset class, and I believe it's kind of like, you know, when we were kids, or I'm dating myself, and my parents were like, oh, what's the internet? So, you know, I don't want to be that dinosaur left behind when all these young kids are talking about, you know, bored apes and cats and other animals that are understand.
Definitely. Yeah, and I'm glad you brought this up. Because that was exactly my next topic, which is that valuations have really like gone up dramatically, and I would say it's kind of started somewhat in the past decade, but then especially in the past 2 years, it's really gone up to the roof. So, and Joe, you mentioned like investor discipline. So, at what point would, as an investor, would you walk away from a deal? And it doesn't have to be numbers, but I'm looking at maybe some kind of, is there some kind of, you know, acceptable range for you in terms of multiples, or, you know, absolute numbers itself, where you start thinking that this may be too expensive?
Yeah, I mean, there's a lot that goes into it. I'm sure Joe can comment as well. You know, obviously if you have like a 2 or 3 time founder, you know, huge technical team, they've, you know, all worked together for years, you know, in a greenfield or a very large TAM or total addressable market, you know, it's going to be higher, you know, probably towards the 40 or 50 times ARR versus, you know, on the low side, you know, if you can get a 20, I consider that cheap these days, you know, for a Silicon Valley funded startup. You can obviously find cheaper, I think, in other countries and in the middle of the country. You know, but, you know, I think about it this way. If I'm investing at like the seed stage and it's already 80 or 100 million, you know, if it's $1 billion company, I'm making 10 times my money. But if I can, you know, I only have so many bullets, you know, and this is the difference between VCs and investing your own money. The VCs, you know, they can always go raise another fund. And I don't mean to be flippant, and I don't apologize to Joe and people who work in VC, but, you know, you're betting with other people's money. When you're betting with your own money and you have, you know, limited number of bullets, you definitely think twice before pulling the trigger. And so there's a little bit of a mismatch in risk there, but you know, I would take a big bet on a high valuation company if I thought they had a really wide moat and nobody else was playing in that field, and I thought they could capture the market, or they could get to 50 or 100 billion dollars. But if you know, if it's between investing in company A that's valued at, you know, 20 and another one at 100, you know, if 20 gets to $1 billion, you know, that's, you know, 50 times my money, right? Or was it 25 times my money? Something like that. My math, like I said, I'm not that smart, but like, you know, if it's 100 million, then it's only 10 times. Yeah, I can do that math. So yeah, you know, I just look at that, you know, I have one bullet. Which of these do I want to invest in?
You know, the other thing too, on the venture side, is motivations are very, very different. So, you know, my motivation is to take as many bets, to fire as many bullets as possible, because I'm getting paid management fees on how much capital I deploy. So like that's a huge motivation, like to go raise a mega fund and deploy it as quickly as possible, and even if it's crazy valuations, because what's driving like that next fund? Well, it's the markups. So like, what's my IRR? And like, that's going to tell a story that, shows success at the moment. And it's very different than when you're an angel, like betting with your own money. Like it's, and because you can, especially as a VC, you can kick that can down the roads like for 10 years before, reality sets in. So motivations are very, very different.
Yeah, that's true. In fact, yeah, some of these figures coming out for long-term VC returns turns out like only about 3% of the funds in the industry are driving about 95% of the returns. And I wonder how much of that is driven by, like you said, kicking the can down the road, because obviously you have 10 years to figure things out. And also the skin in the game factor is relatively low. So when you're investing your own money, every check counts, but you can arguably play around a bit with valuations and other things when you're investing as a fund. But as investors, how would you think one should approach some of these, like, I wouldn't call it mispriced, but well, there's an obvious discrepancy there in terms of perceived value versus what the actual value is. So what would you say is like a reasonably rational approach to play this?
What do you mean reasonably rational approach to play what?
Well, as in
invest in an overvalued company?
Yeah, I mean, obviously the valuations have really gone up. So, I mean, what I'm grappling with is like sometimes, it's a so-called rocket ship that you need to get on, but then you also have your investor discipline saying that if it's beyond a certain markup, you probably don't want to be on that ship. So how do you balance that?
Go ahead, Joe.
Yeah, as an angel, I mean, I think like it just depends on. I'll certainly consider like how big the opportunity is. Like, how big could this be? If they're right. And so that's really hard to like get reasonable returns, because like these companies have to live up to their valuations at some point. And so, I'm not gonna lie, I mean, I did like it's ridiculous, but like the if they're right, it could be huge. It was like 130 or something, like pre, and it was like a seed deal, but like the team was stacked with killers. But like I certainly am looking for value. Like there's a 6 cap that I'm trying to do right now, because like holy crap, like where do you find that? And like the founder's strong, and so those are great opportunities. But these days, like I'm not. There used to be like market prices. That's shifted quite a bit now, as well as like market expectations for like what would constitute like a new round of financing for those companies. So the good thing, the what helps a little bit is like as like a VC, if you're investing other people's money, is your LPAs like sort of restrict you into like kind of what you can do, and that helps make the decision like easier and less emotional, especially as if you're writing your own checks.
Definitely.
Yeah, I think it's tough. I mean, the better you know the company and get closer to management, you get that kind of inside story. It helps certainly formulate, your thesis and how much you're allocating. Obviously, if I'm very close to the company and I know, it's one of the few industries where you can have truly insider information and asymmetric, make asymmetric information and make a lot of money that way.
I mean, my favorite thing about like investing in general, but it is really that like you get to investing in startups rather, is that you get to see like what the future could look like 6 months to 2 years out, and that's like super exciting. And so it gives you a whole different perspective about what's coming, what's out there. It informs a lot of other decisions that you could be making in other kinds of investing as well. So it is super exciting. It's rewarding in that sense.
Yeah, I would concur with Joe. I think it's one of the best full-time jobs if you can get one. Is, you work with the smartest people doing cutting edge technology, and as he said, somewhere between 12 months and 10 years, you're seeing stuff that's going to be commercialized, and you're meeting people that are leading these companies. So and some of my favorite things to do, because I try not to be just dumb capital. I mean, there are plenty of truly passive angels investors, but when I angel invest, if it's direct, and which is my preferred way rather than through a syndicate, I like to work with management. I like to help them out. I'll do biz dev. I'll do strategic introductions, because I feel like as an angel investor, you should be doing that, or as a venture capitalist. And I know a lot of venture capitalists do. I think the angels are less proactive, but you have equity in the company. And so any introductions that pushes that equity forward should be done. So I'd encourage you guys, if you do angel investing and have direct relationships, try to push your investment forward.
I'll just to kind of like add to that a little bit. In terms of like helping, depending on how big your portfolio is, that as an angel especially, that becomes like particularly challenging because most angels have like full-time jobs that aren't investing. And so if on the venture side, there's it is their job to invest full time. On top of that, there's also a lot of support staff usually that can also help to scale that help.
Awesome.
Yeah, I think you also have to be comfortable, like as an angel, you're not going to see every deal, and you just got to take what you see. And there's going to be a lot of dogs, and sometimes you'll catch fire, catch lightning in a bottle, and not catch fire, catch lightning in a bottle, and that's the time to back up the truck, I suppose.
Yeah, I mean, not just that. Like, I think something a lot of people miss as well is understanding things like venture math and in these laws of like just big numbers and making lots of bets where most people don't realize that if you got $100 million fund, let's just take away like the follow-on piece of it, but if you deploy that capital in $1 million into 100 companies, like 90% of those are going to zero. And like that seems like a horrible business, except for the part that like maybe like 8 or 9 of those return then their investment, but like 1 or 2 of those is going to return the fund, and then that's where you make money.
Yeah, totally. Because incidentally, one of my earliest startups was based on a product for VCs, and as a result, I studied a lot of the distributions of these returns, and it's all driven by power laws. Because quoting your example, out of 100, you probably need about 8 or 9 to return your money, and the rest will. Well, that's it. The mathematics is really skewed there, because in a conventional business, if you had those many failures, you would be out of business. But in venture capital, that's all you need. But which brings me to another point, also about like more about your angel portfolio rather than VC. And this is something I have a personal interest in. I've only recently started doing direct deals. So prior to that, it's all been syndicates. How do you typically go about structuring your angel deals? And I mean, I've got a follow-on question, but I'll start with this.
Are you asking how my portfolio is set up, or the actual individual deals?
Well, I was speaking more about the individual deals, but yeah, if you can shed some light on your portfolio as well, that'll be cool.
Yeah, I mean, look, I'll put my LinkedIn profile here. If anybody wants to connect, feel free. I'm very transparent about what I invest in, at least on the angel side. There's a link to a Google Docs. I update all 72 companies, so you can kind of see what I've invested in. I would say it's a very eclectic mix. There is a decent bit of prop tech in there just because of the real estate overlay. If you do connect, just note, just drop a note how we connected, because I do get a fair bit of requests. And so the individual deals, I would say for the most part, I never lead. I look for, and this was going back to a point earlier that Joe had made. I look for an institution, and hopefully a named institution that's been around with a good reputation, to kind of set the mark, because I know that if they've set the mark and I invest, that there'll be other institutions looking on there. So there's good support, and you're going to need that support from the, I don't want to be, the angel that writes that last $25,000 or $50,000 check, and these guys are raising a $3 million round, and then you find out months later that they're out of money, kind of thing. You want to kind of, in a sick way, be the last money in of a round. And that's the ideal, when everybody's, and you're getting maximum value and development. So.
Yeah, I mean, for me, like, there's, maybe like 3 things I can think of right now. Number one, in terms of like picking, like, the first one is like known quantities. Like, if I know the founder well, and I trust them, and I've seen what they've done in the past, like that's a really easy check to write. The second one, just huge opportunities. And again, if they get it right, like it could be a home run, bit of unicorn hunting. And then personal interest, like things that I want to see exist and be a part of. And so those are, I think, like the main things that I'm sort of looking for. You definitely, like, I mean, with a 50K check, like I don't think there's any leading, especially at the seed stage, and certainly not like the Series A. And so you're looking for as much signal as you can get. Like it could be anything. It could be market team traction, existing investors, the individual like founders, who maybe even the person that referred you to that deal. Like anything that you can get at that stage, like is helps to de-risk an opportunity.
Yeah, I would concur. Sometimes if you're close, that's the good thing about, I think, angel investing. If you're direct, is the best, because you can, even if you have a 10K check, that the CEO will always take a call or email, because you're an investor, and you can often glean a lot of insights. How are you guys doing? And I think by offering help, and usually the way I offer help is through my network, or introductions, or things like that, you'd be surprised what you get back. I mean, I've been offered advisor shares, come onto the board, things like that. And none of these things I've asked for. I was just being a good guy and just trying to push my equity forward. So.
Yeah. And even to get into a lot of these deals, building, like, people become known quantities over time. And so, although it's not as like, common the last couple of years, I mean, 5:45 Pacific on like a Thursday night, like I am out at like some event, pressing the flesh with entrepreneurs and investors and whatnot, just building the network. And so that's or even this opportunity, to get to know people, is sort of like networking still. But yeah, I mean, that's kind of like how you build that network, and have those opportunities, like especially as an angel, like those opportunities just don't come as often as like you're a brand name fund, that where people are just like, that's who I know. Like finding an angel is a lot harder than identifying a firm.
Definitely, which is exactly my next point, like my next question, which is how have you gone about like finding these deals? And just from my own personal experience, all my initial angel deals were get on Angel, the syndicate and whatnot. So it's only now I've been getting some inbound LinkedIn requests, or through people I've known, or invested in, their friends of friends and so on. So, but is there a more structured process you might have, or is it some people have also suggested angel groups and all that, which I'm not a part of yet, but yeah, I'd love to hear your thoughts on that.
Me personally, I mean, I used to, before COVID, when do a lot of kind of meetups, and kind of there would be a lot of pitch events, ERA, a lot of the accelerators. I find now they're all online, and it's even easier to get access. So I enjoy kind of deal hunting, looking at stuff. There's a lot of work involved, like literally, if Y Combinator had like I don't know how many companies come through for their demo day. If you wanted to do that, there's a lot of brain damage involved, but I kind of enjoy that process. Some of the smaller ones, there's like Deep Tech Showcase, and there's a few other ones that I enjoy. I get unsolicited emails, unsolicited LinkedIn come through. I'm in a bunch of Slack channels and various types of social media channels, LinkedIn groups, and Asian Investor Network, and then just your personal network. I do think there's value if you build that network. I mean, I've used a lot of different tools. I think I like Lunch Club a lot. I don't know if anybody's ever used that. I think it's great for just meeting other professionals. At least for me, I find that there's a lot of startup founders and a decent number of investors on that.
Yeah, I mean, it is a lot of your network, getting referrals in. Part of it is just kind of like being known to make angel investments, so that people can, come in and find you as well. And, it is also just being part of other large networks, like whether it's for startups, again, like for like YC, or I'm part of a mentor for 500, and actually, like, after this call until midnight, I've got back-to-back like deal calls with a bunch of companies, and actually just invested in one 2 days ago. Yeah, I mean, I guess just just like, I don't know, just being a known quantity for others and just being helpful. It isn't always that, like, I'm going to invest in something, but I do believe in making like these sort of investments with my time into companies, and it might not be like this deal, it might be the next one, or that one that they refer. And this has happened all the time, and I'm sure it's happened for Joseph as well, where just by helping, like, I don't know, it's weird, good things come to you.
Yeah, I would agree that 100%. One other tip, if you really want to get a lot of unsolicited, deals, but I think there's value in just looking through deals. You're gonna kiss a lot of frogs before find prince. Just put on your LinkedIn angel investor. I find that helps, and you get a bunch of unsolicited LinkedIn requests and decks. I think my email is out there floating somewhere on a early stage tech list in the Twitterverse. So I get a lot of unsolicited emails. I would say 95% of them are pretty garbage, but once in a while I do find some gems. So you just can't, never judge a book by its cover. Don't discount it. Even if the decks are sometimes crappy, I'm like, oh, there's something here. Sometimes I'll take a call.
I agree.
Yeah, definitely. I mean, on that note, I'd love to hear your take on consultants approaching you for deals, especially early stage deals. Personally, for me, that's kind of a no-go territory, because, but I also wonder if I'm being biased there, because I think reaching out to investors is a skill in itself, and when you outsource that, I wonder what you think about that.
Yeah, personally, I go direct. I mean, whether the consultant's paid by the company or, I never pay for deal flow. I mean, there's too many deals out there. Now, certainly if you're talking a bigger raise, or there's a certain specific niche that they need to, then, I've seen capital arrangers, but I see that more on the private equity side, not so much on venture, until it gets to past A, B, C maybe, but pre-seed, seed, definitely the founders should be selling. It's a lot of good training if they're first-time founders, because they need to be able to sell themselves in the company. And if they can't do that, that's a huge red flag for me. Yeah,
completely agree. Huge red flag. If a lawyer or a banker or some consultant is like bringing deals, it's like kind of an immediate hard pass, partially because I just don't have time. And what it signals is that, like, the founder themselves either usually isn't scrappy enough to go through the, I mean, it is kind of a like protocol and process, but I'm going to take a meeting if, for instance, like I don't know, if Joseph like referred me a deal, like, and I trust his judgment, and he's in the deal or whatever, like, I'm more likely to take that meeting. And if they're hiring someone to do this this work, and by the way, like hiring those people is really expensive. They charge a criminal amount to do that work. And so it's just a negative signal at a time where you're looking for signal to do deals. I mean, people ask all the time, it's like, hey, can you introduce me to this person? I was like, sure, if you make it easy. And like, why you? And people go like, oh, I don't have the network. Or I was like, did I wake up one day and like was born into a network? Like, no, like there's a lot of work that went into building that.
Absolutely.
And something that
value.
people absolutely, and one thing that like people don't realize is that to do an intro requires spending social capital. And so so like, while I could, and this is assuming that they've done the work to determine like that this person is somebody that they should be talking to, because then it's like, hey, do you know any investors that that might be interested in my company? It's like, yes, and like, versus like, hey, can you introduce me to I just see the name here, Yik, for instance, because I saw that Yik invests in prop tech, and that's what I do. And none of his portfolio companies compete with mine, and he wrote on Twitter the other day about this problem that he's like having, and I solved that. Like, that's an easy one. And by the way, like, if you write the email for me and make it really easy for me to do the intro, even better. Like, those people are high quality. What you're trying to, like, what the banker or whoever is signaling when they're coming to you with a deal is that this is a low quality, like, hard pass.
Right. I think if you want to make friends, the best way to do it is to not ask for something, but just figure out how you can add value. Like, if I wanted to, like, whatever, if I met Joe for the first time, which I do with all my relationships, I just say, what are you into? How can I help you? And if I can add value to him and be like, oh, you need to meet somebody here, guess what? Joe's going to really immediately remember, and that's same for guys who are founders or guys who are aspiring angels. The best thing you can do is, deal hunt, find an amazing deal, bring it to somebody higher up on the food chain. That's what I do. I have a bunch of VCs that are pre-seed and a bunch that are later stage than me. And I'll take deals from the PC guys when they're like, oh, we're ready, take a look at our company. It's getting mature. And, I trust them. And then when I have deals that I'm like, oh, this is really interesting, you should take a look at it. And if it's a really great deal, like if I sent Joe a deal and it's amazing, he's going to be like, thanks, that guy has pretty good deal flow.
Yeah. I mean, and with regards to like those referrals, like at Social Leverage, we lived by the mantra of this idea of like the peloton. And people would always ask all the time, like, hey, Social Leverage, like, you guys invest in like nonprofits or like social networks and all this other stuff? No, we actually like to make money. And so what it was all about was, again, this idea of like this peloton where you're riding together in a direction, you're helping each other. Sometimes somebody's going to ride in front, like and someone's going to slip behind and conserve energy, and you're just all helping each other. It's all about help. And that's why, like, I sort of give my time, what little there is, like, freely, because it is this idea of like making these social deposits and building social capital with people, because one day I may want to make a withdrawal. And and that's worked for incredibly for us, because it's just like, hey, we got this portfolio company who is looking to exit, or we think this is a great fit for over here, and be like, hey, can you connect us with or with this company, or like, I need to talk to your corp dev guy, and boom, sold. Right? Like, it's a relationships. There's a lot of relationship stuff going on, and it doesn't have to be so transactional, but it is this game of like give and take. Yeah.
And I would highly recommend, if you want to get in this game, to dip your toe in the water, join some syndicates. You don't have to invest. You can read about, it's free to read on AngelList. I don't even know if they really KYC you as an accredited investor. You could probably just get on there. Yeah, just dip your toe in the water, join some angel groups. That's relatively low cost. You'll learn the ropes there. There's plenty of material out there. Talk to folks who are angel investors. There's never been an easier time to become an angel investor, right? To find deals. You have like the crowdfunding through Seed Invest, Republic, all these ones. Although I tend to think the deals on those tend to be lower quality, but still.
Yeah, I mean, I would say the same thing about like, you're always going to be trying to look for, you're trying to discern quality and filter for quality. And by the way, like filtering is a huge part of this job, huge. If you have no other skill than like even being able to filter, like you'll actually do pretty good. And that's another thing that like founders don't necessarily understand themselves. Like, I think Prasant, you're a VC, right? Like, people don't realize that you're seeing like 3,000 deals or 3,000 opportunities like come into your inbox a year, and that you have limited time to like filter them all. Like maybe you'll talk to out of 3,000 like 100 companies, and then you'll do like 10 deals, but and then all the while supporting existing portfolio companies, trying to raise a new fund and everything involved. And so yeah, I mean, if anybody in here is like starts to get into investing, you'll be, as you ramp up, you'll be inundated with opportunities, and it's setting rules for oneself is a good way to get back some of that time and also filter for quality.
Yeah. One other thing I would say is if you do it, I would definitely, even just in general, build a CRM, use HubSpot, it's free, or I'm too dumb, I use Google Sheets, but just I track everybody I meet, email, name, little notes, what are you into? You like real estate, venture capital, PE? Oh, Joe does collectibles. Okay, so I'll remember that.
Yeah, definitely. We're almost like coming up to the hour, so I'll close out with two person questions. So I'll start with Joseph. Joseph, you seem to be really into cybersecurity as a theme. So what are some breakthroughs in that sector that you're really excited about?
Yeah, well, I would, biased, but my number 2 largest angel position is a company called Q-Secure. I'll put it in the chat, or if anybody wants to see it, there's actually a syndicate being run on it right now by myself, but very, very interesting company. It has to do with the fact that quantum computing is coming. And if you understand anything about public key infrastructure, PKI runs anything on a chip. So you have existential risk coming. When they get to about 4,000 qubits stabilized, you basically own the keys to the kingdom. So the TAM is massive. And then we've seen with SolarWinds and kind of, the Colonial Pipeline attacks, we know that sovereign states are actively deploying hundreds of billions of dollars to hack us. So the US government is now putting legislation in place that says all US government computers and all vendors of the US government must be post-quantum cyber secure by X date. Now, whatever that date is, work 10 to 15 years back, because that's how long the US government will take minimally. So now I've got existential risk with a technology phase shift, massive TAM, government involvement. This company has software that's deployable today. They've got customers. $1.5 trillion asset manager called Franklin Templeton is a customer. So you can feel fairly comfortable that the DD has been done. The last piece of signaling, is that they have a competitor in the UK called Arkit, ticker's ARQQ. They raised $400 million on a $1.2 billion SPAC, traded to 5B. They're probably like 2.5 now. They have less than 10 million revenue. They have UK government contracts. So the space is white hot, but it's definitely, I wouldn't profess to be anywhere near a quantum or cyber security expert, but, when you have large name players and more importantly, large name customers that have done DD before you, not to say that everybody's DD is great, but, that's another piece of signaling that you can use.
That's awesome. Sounds really exciting there. Joe, very similar question, just based on your background. I know you've done a lot of work with collectibles, but for investors, what are some of the things like beyond collectibles or even NFTs, or what are some trends we should watch out for?
I mean, just broadly, like fintech is obviously white hot, and that takes a lot of different forms. There's a lot of sort of DeFi type things that are really popular and have potential, but wildly overpriced. But there's also a lot of like BS out there too, so be careful. Yeah, alternative assets just in general, private investing also huge. I guess that's all still fintech. I think our our relationship with money at the moment globally is sort of like pretty screwed up. So there's a lot of opportunities where there's a lot of uncertainty. So I mean, even just as like a rule, I don't know. It's kind of like the buy when there's blood in the streets kind of thing. Like if there's something like going sideways, like there's opportunity. So
yeah, definitely. That's I think. I mean, to draw a parallel, I think after every kind of these major, like 2008 was, it was around 2008-9 when some of these educational and lending companies were taking off, right? So I think it can be very thematic pertaining to that particular era. So, but yeah, definitely. I guess those are all the questions I had. Sam, are we opening it to
I'll
the
stick
room?
around for like another 20, 30 minutes if folks want to just, turn on their cameras and ask questions. I see there's some in the chat. If Joe, Sam, you guys, I mean, I don't know, do we have a time limit on this, Sam?
No, if you're free to stick around, that would be, I'm sure the attendees would love that.
Yeah, if you guys want to just come off, you got to turn on your video camera though. That's the one request I have. I think Michael has some questions. Michael.
Hey, yeah, I asked one earlier in the chat, but I'm just wondering, like, what percentage of people's personal net worth are they putting into angel investing? This obviously is differing by person. I'm probably like 8% right now.
I think that's a little bit of a tricky question because it really depends on your risk tolerance, how much you're earning, where, is that your, this is my kind of full, I don't have a W-2, this is what I do. So I have a higher percentage of my net worth in angel investing, probably over allocated, some will say, but it's a personal philosophy of mine that, I'm, betting one could go to zero, but I'm playing for that 100. And I always figure, could always make more money later if I lose it.
Yeah, I mean, same thing. It is a very personal question, and so I actually have no idea. There's just so many deals like flying back and forth, not just in angeling, but in everything. So, I mean, if I had to venture a guess, like I don't know, 5 or 10, but yeah, I don't know. I see a lot of deals too now with like Sydecar because we compete against AngelList. We do a lot of deals, and so which is like also another sort of source of deal flow and kind of an unfair advantage because these deals are getting done, and they're like premium deals. Like I don't know. We did like the last Stripe deal. We're doing the Reddit deal right now. We did like the FentiX Savage deal. And we got like tons of smaller ones too. So, but yeah, something to that effect, if I had to guess.
I'm a little higher, probably 20%. Other questions?
I had a question for you guys on investing. So I'm also real estate investor, do mostly multifamily, but do you guys sort of compare investing, I guess, returns or metrics like across the board, or is it more like, okay, this is my buy box for, I don't know, in a real estate deal, and this is the buy box for venture, and I'm wondering how you compare, like, is it IRR, is it, because when I look at a real estate deal, I can't invest in something that has a 5% chance of winning. It's a lot of capital at stake, stuff like that. But the venture model is so different because you're investing for like the 5-10% of the deals that are gonna, I don't know, 100, 500x. So how do you guys like think about that?
I guess I'll go first. I mean, half of my portfolio is in real estate, so that kind of pays the bill with cash flow. And, I consider those more stable, although you can lose your entire principal depending on what kind of deals you've done, and certainly have in past deals. The venture, yes, definitely more risky. My LMO, usually the way I like to do it is, I try to get in with the minimum check size, ask for pro rata if they have it, but just track their company, because I can't, even if it's the best company, I can't control the market, I can't control competition. So there's a lot of things outside my control. Even the CEOs can't control for. So as the bad ones go out of business, knock on wood, I've only had one so far, but the 72, but then the good ones kind of either zombie along, or the ones that are really accelerating, I try to add more fuel to the fire, in later rounds. So, that at that time, maybe if it's like a series A or B, I'll raise a syndicate,
Yeah, I mean, I think like angel investing should never be anybody's like first foray into investing. It is so risky. And it's not like venture where you're investing other people's money and getting paid either way. And so yeah, it just depends. Like for me, like it's just it could be a deal in whatever, right? Like it could be a real estate deal, it could be a collectible deal, it could be, just wherever the deal is. I had somebody call me yesterday and was like, hey, like I've got like 100 original Michael Jackson, like original art. Who knew Michael Jackson was an artist? I mean, like painting. And so the deals are always constantly coming. It's just a matter of for me at least, it's a blend of things. I mean, some of the things are going to be like you were saying, like real estate, cash flow, and so that's great. So that's that has a different return profile and risk profile. And then on the other end of the spectrum, you've got like investing in funds or investing in angel deals that you hope are, first of all, most of those are going to zero. Let's be honest. But like you hope you have 100 bagger in there, but you never know.
So,
and then
so
everything in between.
yeah, the strategy is sort of, I mean, your funnel is just like a really huge funnel, and you invest in like, I don't know, 1% of that, and then the 1% of the 1% are gonna, make your returns. And then it's like a 10-year to figure out, like, I saw your note in there, 2016 investments, like you just don't know how they're gonna do for a long time, right? So you're just kind of playing the long game.
Yeah, I mean, look, I can't control market timing either. I have a company, that Q-Secure company, I think I see liquidity in 12 months, but that's because that particular space is lightning hot. I mean, white hot. The other company, my first investment, it's, a slower growing enterprise deal, but you just can't, it's not like I'm investing with rent money. First of all, it's you have to have your expenses covered, and basically the way I look at it is I'm generating alpha through these kind of small diversified bets into a bunch of different companies, and I'm investing one, could go to zero, but I'm playing for that 100, and we'll see.
Yeah, I mean, it's kind of the same thing. Like, it's sort of like applying venture math to your deals. I mean, like the more you do, and also like the higher quality you do, like you can expect. I wouldn't say expect. Like nature sort of like pushes things toward like higher alpha over time. And at least for me, a lot of this stuff is, I mean, many hoses dripping into one bucket. And so, as long as the bucket's getting filled, you can do more deals. And like some of them are going to be kind of nascent for a while, and maybe they'll blow up, or maybe they won't drip anything into the bucket, but that's okay.
Yeah, this is a very long game. It's not a, sorry, crypto guys, a 3-year 1,000% return overnight.
And that's okay too.
Yeah.
And you have, along with the rest of the portfolio, you have some exposure in that as well.
Yeah, I mean, certainly I like real estate. I'm a real estate guy. I love it because it's a hard asset, and relatively inflation protected. A lot of things you can do with it, but the growth, your target IRR, I'm happy when I get, low 20s for an IRR. I don't think of it in terms of IRR. I think of in terms of, MOIC, which is multiples on invested capital for venture angel investing.
Thanks.
Any other questions?
Hey, my name is Trevor. I am not an angel investor. I just do normal investing. I just recently got into crypto and stuff, but this has been really enlightening just because, I'm a filmmaker, and I'm here for a reason. I'm like, how do I get investors to invest in my projects? But it seems like you guys tend to be almost like the executive producers of these companies in film talk. You're finding them, you're kind of leading them, and giving them sort of fuel, to make it happen. And my question is, what are your end goals when it comes to VC and angel investing, or angel investing actually? Like what is the overall sort of achievement that you're striving for when it comes to putting in all this capital, time, and energy? Do you want to see change in the world? Do you want to, grow your nest egg as big as possible? Do you want to buy an island? Just curious, what your end goal is. And yeah.
I'll go first, but I think, look, I'm a capitalist at heart. I want to, have financial freedom. I mean, I'm not poor by any means, but there's a number in mind. But I think the game only gets bigger. Me personally, I'm a little bit of a deal junkie, admitted deal junkie, and I just like to do more deals, bigger deals, cooler deals. I don't ever want to run a venture fund. Not anything against that. I just think being a angel or super high net worth is a better game, because you don't have LPs you're responsible to. So you decide how much you want to invest, when you want to invest, where you want to invest. It's the ultimate freedom, investing your own money. When you're investing venture, it sounds cool, but there are handcuffs. There's a 10-year handcuff that comes with that. So just be careful what you wish for.
Yeah, to that point, in venture, like the motivation is return capital. And so, ultimately, like, I think we're all underlying at least most of it. We're trying to, earn returns, right? Like make money on money. And, I think at least when it comes to, strictly to angel investing into, startup technology deals and that sort of thing, or really anything else, maybe it's films. It's, for me, it depends. I think this could return a lot of capital. This person is just a really great person. I want to work with them. Or I really want to see this thing in the world. And so, that's kind of like, there's different motivations, at least for me, when I'm choosing what to bet on.
Yeah, to follow that up, I think as you get bigger and you have more discretionary income, certainly philanthropy is important to me, but I believe more so than just a handout is impactful investing. And what I mean by that is, obviously ESG impactful, but I want to invest in projects that are flywheels for good. So if I can invest in a company, I don't necessarily have to have a massive return, but I want the company to be successful because they're doing good, social good in the world. That's certainly, I think we need more entrepreneurs investing in those companies. I don't think we need another social media company. We need other real world companies doing stuff.
I would echo that as well. I mean, even when we exited Mythic, we chose Sydecar for a number of reasons, but we primarily because they were founded on this radical idea that anybody should have the ability to invest in those entrepreneurs that are changing the world. Even if they're not doing it themselves, they're creating those opportunities for those people. We turned down StockX, we turned down eBay, we turned down Kraken, we turned down like half a dozen others to go to, because we believed in this company's mission. So there's that too, and the money doesn't hurt, but that was a determining factor.
Cool, thank you. And also, Joe, like, what are you most excited about when it comes to a current project you're invested in? Because Joseph, it seems like you're pretty interested in the quantum computing thing, which seemed really awesome.
I mean, quantum is interesting, but way above my pay grade. Like I don't, I know it can, make a lot of money, like, but it's just, if I don't understand it, I'm gonna lose money, or I just can't be helpful, and it would be a disservice to anybody taking my money for me to be involved. Yeah, I mean, like I said, like fintech, like fun things. I get a lot of joy out of again, like sort of collectibles. About to invest in a company doing something in that space. Yeah, I mean, I have fun when I do this, and it could be anything. And even some of the companies that may be struggling right now, and may do something big. I spend a lot of time with if I really sort of believe in it, whether it's the founder, the idea, or again, like those things I spend the most time with are the ones that either I can be helpful, but more importantly, like when allocating my time, something I think that just should exist. And so, and there's a few in the portfolio that I spend a lot of time with. Others I spend like no time with. So, yeah.
Well, thank you, and thank you for the information.
The fintech question.
Yeah, I think he had a fintech startup.
It might be like just a broader question about like how to get in front of investors, whether angel or venture. And I don't know if Prasan is still in here. He could also maybe opine on this, but like because of the constraints on like time and signal and a number of other things, like warm intros always the best. Because even though you're not a known quantity to me today, you're a known quantity to this person I trust, and that makes that intro so much easier. What would you look for? I mean, I guess it would depend on the stage, seed stage. I think like the rule of thumb tends to be market team and traction. And so like that's sort of a blanket statement. It's sort of the medium, the medium post advice. But in truth, like there's a level well above that where if you see lots and lots of deals, you realize like what separates the, and this is just an idiom, but like the men from the boys, where you can tell someone's just is more likely to make it than maybe somebody else because of quality or capability or whatever. If once you have seen or are aware of like what's possible, like nothing's impossible. But like if you're taking just sort of blanket medium article advice, for, I don't know, let's take an example, how to make a deck, like you're optimizing for average, and most people unfortunately don't know what great looks like, not just like with making a deck or pitching a startup or whatever, just in life. Progress, there are market expectations of like progress depending on the stage. If you want to like raise pre-seed or seed capital between, let's say, 250K and like $5 million, like there's a number of factors that all kind of bake into like market team and traction, and then the type of company as well. So there's certain, if you want to raise like $2 million for like a SaaS company, hopefully you've got like 100K ARR. If you want to raise like a $5 to $10 million like round, maybe you should be trying to optimize for like at least $1 million ARR. take that with a grain of salt, because things are very, very different these days, because of, there's so much capital in the market, and capital is no longer the constraint. It's like great opportunities. That's hard.
Yeah, just to follow on that, I don't invest in pre-seed. So, as a seed stage company, I'd want to see product market fit. That means you have somewhere between 250 to 500,000 of ARR. You've got a full team. You've got a product, not an MVP. You've got some clients that are referenceable, and that's where I generally get involved. If you're just two guys in a deck or an idea, I tell you, come see me the next round. So it really depends, as Joe said, on the stage.
Yeah, just to add on to that, I have done a few two guys in a dome kind of deals as well. But again, the common thread I would say has been the team and the traction. So, well, some people do, when I chat with them, they talk about the fact that they've heard, or this is all conjecture. They'll say, "Oh, I've heard a friend of mine raised capital just from a pitch deck and all that." And yeah, maybe it's true, but it's one of those mythical animals that we've heard of but never come across. Even that may be a lot easier if you're a repeat founder. If you've had 2 or 3 great exits, I'm sure it's easier to raise capital from just a couple of like nice slides and all that. But for the rest of us, we have to hustle and show some traction. So whether it's like a really steep graph in terms of users coming on board, or your revenue numbers, or whatever the metric you're optimizing for, you have to be able to show the growth there. So that's definitely there. Also, I mean, in the early stages, it's very unlikely you have some kind of product market fit, but and also, like, even if it's a Series A company, what the company looks like at Series A is not what it may look like at Series C. So pivots will be there, but just adding on to what Joe said, it's more to do with capital is no longer the constraint, so you have to look at other things.
Yeah, I mean, I've definitely done like some like really early stage stuff, pre-seed or first check-in even, but the caveat is that they were a known quantity, usually years before ever looking to raise for that project. And not just known quantity, like I've known them for so long that like I would bet on whatever they did.
Is anybody in the audience an angel investor or thinking about angel investing? Hopefully this was helpful.
Yeah, I did have one question, Joseph. I know you covered this earlier. In terms of, what's the best way to become an investor if you're not yet accredited, for example? I know you mentioned or recommended working with either, an SPV or a syndicate group. And if you have any recommendations or how to look for a syndicate group that's, I guess, kind of ideal to the types of companies you want to work with. I mean, I've started in crowdfunding, but what would you suggest is kind of the best approach to this particular industry as an investor?
So a couple questions in there. I think just jumping in or paper trading, I think the best learning is just, kind of getting your feet well, not to say dump a ton of money in, but I think Angel List or Angel Co is pretty good. They have a bunch of syndicates on there. You can with various people doing various different types of investing, some early, some late, a mix and match. And you yourself have to kind of figure out a thesis of, what you're comfortable, what stage you're investing. Like for me, I run my own capital, so I can't take pre-seed risk, but I feel like by the time it's to Series A, they have professional VCs in there. So I just can't add as much value to the seed level stuff. And quite frankly, the risk reward, as I said, if I'm going to invest in an A at 100 or a seed at 20, I'd rather invest in the seed because, my multiple upside is better, assuming they both exit $1 billion. That's always kind of the mark. And not to say that they will, there's some stuff there, but I think that's a good place to start. There was another piece of your question. Sorry, what was the earlier part?
Yeah, the second, basically you kind of cover that. primarily if you weren't accredited, of course, right? A lot of times they do
Oh, yeah,
recommend.
so-
Yeah.
So the IRS has changed that definition. Accredited, if you go on the definition, it's now inclusive of sophisticated. Now, I don't know what sophisticated means. That's a
Mhm.
very gray area, and maybe Joe can comment on that. But look, if you KYC, that's know your customer, and you sell for credit, I don't think too many people are checking on that. And that's not a legal advice, but I'm just telling you, if you wanted to just get onto Angel Co and look at deals.
Yeah. So on accreditation, actually being accredited, I mean, you can, first of all, most of the time it is self-attested, and most of the time people aren't checking. That is true. You do need to be accredited, in one way or the other, on like for AngelList. And so, but you can also become accredited by becoming sophisticated by, anybody can go get their series 8, is it? That
65.
okay, 65 to go and become accredited. And so so yeah, that's another way to do it. Now, what's available for people, let's take crowdfunding, Reg CF, like that's available to anybody to get involved with. Reg A plus is something that can anybody can also get involved with. I mean, and then if you do become, or you do want to get into deals where you can self-attest, those are going to be like 506B deals. But if you want to do a 506C deal, then you're going to have to prove accreditation or be a qualified purchaser. So I've dropped a whole bunch of stuff out there that I don't know if probably needs some clarification about like the different regs, but there's a lot of ways to invest in stuff. So
Gotcha. Thank you.
and
I
Dave
took,
is great.
took some notes here. Thank you guys. I appreciate that.
Yeah, I just checked this. So in addition to the Series 65, apparently you can also do the Series 7 or the 82. But if your question more about just getting the experience, you can dip a toe into this through Seed Invest or even Republic. But like Joseph mentioned earlier, some of the deals may not be as high quality as others, although Seed Invest does claim to have a really high bar for allowing companies into, onto the platform. But again, it could be good training ground for you. So you could, in theory, run like a $5,000 angel portfolio, spread it across 100 investments or something, see what kind of returns you get. Obviously, it'll be a while before you see returns, but at least you can see in terms of traction and how these companies are faring. Could be a good mental experiment there.
There's no better way to. Oh, sorry. Go ahead.
No, I was gonna just say, same idea. You could do it on Angel Co with like $10,000 and do it, because most syndicates, I think the minimum is 1,000 or 2,000. So, and it's good to you read their bios. You tell, you can see what they've done, where they, what kind of deals they're invested in, because it lists on Angel Co and it usually tells, oh, these are the kind of deals we're doing early or late. So, and then you read their deal memos, and then you learn, okay, what are they looking at? You look at a bunch of decks. Oh, well, these guys like it because of this, or this, right? And as Joe said, it's a lot of pattern recognition.
Yeah, and on top of that too, even if you're deploying $1,000 into these deals, or if you're doing a Reg CF deal and you want to deploy $100, you your relationship with like that company changes dramatically. It's kind of like if you own a single share of, you may not give two shits about like Tesla or GameStop or whatever. But if you own a single share, you're probably going to care a little bit more, and you're going to watch, and you're going to track it, and you're going to start to learn something. So that's, I mean, I would say like, even in small quantities, it's like worth kind of deploying capital so that you're training yourself to get into the mindset of like paying attention to this stuff. So you can train yourself at much lower check sizes to recognize like patterns and things like that too. So.
Gotcha.
Yeah,
that's a good way to look at it. Yeah, get some skin in the game. You're investing in it, so obviously you got to care at the end of the day. So thank you for that.
Consider it your MBA tuition to investing.
Yeah, and then I think Joseph put down a bunch of like SPV managers, including Sydecar. Shout out to Sydecar. Sure sucks. AngelList is but and like no bullshit. Like talk to anybody that's run a deal on Assure. Like you'll hear it. But yeah, I mean,
bad.
oh, it's horrible.
Yeah.
Prepared to pay and then be abandoned. But Sydecar will never do that. But
do you work with Dave Meister? I talked to him a while
yes,
back.
I do.
Okay. We'll
Yeah.
chat about that. Nice.
Joe, did you say that Assure is not the deal flow in there is not good? Is that what I heard?
It's not the
No,
deal flow.
It's the actual system, which is pretty crappy. The technology is horrible. I've never used Sydecar. I mean, I've been an LP on Sydecar, but I've used Canopy, I've used Assure, I've used Angel. I like AngelList because everybody's on that, and they make it's the most robust and the most LPs, but there's also no differentiation. There's like literally a gazillion syndicators on there, so it's a double-edged sword.
Gotcha. Thanks for the tip.
Yeah, and on top of that, I mean, it's again great to see the kind of deals you get, but like one bit of advice I got when I first started was just to sign up for as many syndicates as possible, which is both good and bad because you see the range of deals, but also you get a ton of irrelevant deals. So not everything's, but maybe you can use that as an exercise to like start building your own mental models and see what kind of deals like you're interested in, in terms of sector, in terms of deal stage and whatnot. So yeah.
Right.
Even seeing these is just getting the reps in, right? Like if you join a syndicate and they're sending you deals and you just go look at the deck and you got to train yourself to recognize these patterns, and you don't have to invest in them, just see them.
Yeah. Another pet peeve of mine, and I don't know, maybe some people do this is, and I get it, not everybody has, as much dry powder as other folks, but, syndicators who put in the minimum like 1,000 and they do like a deal every week, those guys are spraying and praying and just getting super leverage on their LPs. I question, what kind of diligence you've done and how committed you are. When I run a syndicate, I'm putting in minimally, 25, 30 grand and more. Usually I'm the largest, position in the syndicate. So, because there's nothing that tells you more about conviction when somebody puts their own capital to work. You should ask the syndicate lead, like, why are you guys only putting 1,000? Maybe it's because they want to leave room for LPs. Okay, that's fine. But and they have a small allocation. But I often raise that question. Why are you only putting 1,000? And if you have such high conviction on this deal, it's a fair question.
Usually it's they're 2 and 20s, but yeah.
No. It's 2 and sorry. It's 2 and 20, but I'm saying they're putting in the minimum 1,000. The GP is putting 1,000, which means that they're getting huge leverage as opposed to putting a chunk of their own. So that's
100%.
My thing. And look, not all syndicators are created equal. Recently, it came to my attention that there are guys who are sub-syndicating, like partnering with other guys, which happens a lot, but where they're claiming that they're direct to the company, but they're not. They're through somebody else's syndicate, and the company doesn't even know who these guys are. So you've got to be careful. And I think it's getting to that point on AngelList where you've got guys who are like, oh, I'll become a syndicator, and they don't know what they're doing.
I had a follow-up to Mark's question. So I guess when you are first getting started in it, you guys can, pick individual companies, but it seems like maybe the starting point is to vet out a syndicator, and at least there's some vetting process there. Someone's been doing this for a while. They've invested in a bunch of deals. So to vet that, you talked about skin in the game. Do you look at, like a track record? And I know these are like long deals, 5-10 years. So, and some, I don't know, some investors might have, some crazy exits, but that doesn't mean it repeats, I guess, right? So are there like certain things that you guys would look for if you're investing in other people's syndicates, or like a thesis that makes sense to you, industries that you follow?
Yeah, I like the guy, guys that get good deal flow, really interesting deals where I think they're strong. I'll follow them. There's a few guys that I like, and then it also has to match up with my investing style stylistically, right? Like I don't follow any pre-seed, or I don't invest in any pre-seed syndicates syndicates, right? Because I just don't do pre-seed. So, and I don't do late stage. So, I have that very kind of narrow. So, and then I would just, when you go to apply to syndicate, say, hey, can we get on a call for half an hour? I'd like to understand how you think about, when you do your analysis for, what are you doing? What kind of diligence are you doing? How do you think about, your portfolio companies that you work with? Those are all legitimate questions you should ask.
Yeah, when you're thinking about syndicate too, you can kind of think about like a syndicate almost as like just like crowdfunding, whether it's like a start engine or a seed investor, whatever, just with like, larger check sizes. A lot of it is just kind of like, hey, we're kind of like throwing it out into the ether, and we got like enough people that, have capital that they want to deploy that we can fill this allocation. And so it's maybe not exactly, but it's kind of like crowdfunding.
Sam, thanks for putting this together. Joe, pleasure to, and Prashant, thanks for hosting as well. It was fun. And hopefully you guys found it entertaining. Feel free to connect. Like I said, my LinkedIn's on the comments. And if you have any questions about Angel or my syndicate, and Joe runs the syndicate too, I'm sure he has lots of insightful things to say.
Syndicating deals right now. So if anybody's looking for deal flow,
yeah, same.
Thank you so much, Joseph and Joe. Really appreciate your time and insightful answers.
Yep. Have a good night, gentlemen, ladies.
Thank you for joining us today. If you'd like to stay up to date with us in the future, please subscribe to our YouTube channel, visit our website, and join our Facebook group.